Welcome back to the deep dive. We've got a really critical mission today. We're navigating the sources on future-proofing portfolios for the AI era. Look, if you're feeling like the economic ground is kind of shifting under your feet, well, you're not wrong. AI is fundamentally reshaping, well, everything. And whether you're trying to make smarter investment decisions or maybe just figure out your own professional future, the knowledge we're digging into today is frankly essential.
That's precisely the challenge, isn't it? We're not just watching some slow incremental tech evolution anymore. The sources we've looked at paint a picture of, well, an immediate and pretty profound acceleration of change. We need to be clear right up front. Those reliable traditional investment strategies, the ones that worked great for the last, say, 2 decades, they're rapidly becoming insufficient. The sheer speed of this AI disruption, it just demands a new playbook.
Absolutely. So our deep dive today is really designed to give you that playbook. We're going to unpack the current scope of AI disruption, what's happening now. Then we'll identify the specific economic vulnerabilities, the fault lines, if you will. We'll define 3 key pillars for what we're calling an AI-resistant portfolio. And then, and this is critical, we shift focus from just financial assets to your personal assets. We'll talk about the essential human skills you need to thrive, not just, survive this. Okay, let's start with the hard evidence. The AI tsunami, as some sources call it, this isn't science fiction. It's already driving huge shifts in efficiency, market value. Tell us what the sources reveal about the scale of disruption that's already underway.
Well, the scale is staggering, mainly because the impact is so quantifiable now.
Yeah.
For example, the sources detail how generative AI is just slashing R&D timelines. Take drug discovery. We're seeing timelines that used to be maybe 5-7 years, now cut by nearly 40% in some cases. That shifts billions in projected R&D spending and basically redefines the competitive landscape almost overnight.
Wow, 40%. That's immense. It goes from being like a competitive edge to just the basic cost of entry, doesn't it?
Exactly. Or look at logistics. Autonomous systems driven by AI, they're optimizing supply chains, warehouse ops, down to a fractional level of efficiency that humans just, well, they can't match. And this isn't just about robots replacing some workers on a line. It's about fundamentally restructuring how global commerce even moves. This acceleration, this speed up, that's why I keep talking about exponential change.
Exponential change, right. That's a term that gets thrown around a lot. But why does it make, taking action right now so urgent for our listeners?
Because our old way of thinking, linear thinking, it's dead. The speed of AI's development, the way its capabilities compound year over year, it means that falling behind by, say, 2 years today, that's maybe like falling behind a whole decade, 20 years ago. So if you wait to see the trend stabilize before you adjust your portfolio or maybe your career path, you've already given up the critical advantage. Being proactive isn't a luxury anymore. It's basically the core requirement for future-proofing anything.
Okay, let's talk risk then. But hold on. If we're talking about the scale of displacement, this exponential change, isn't there a risk just fear-mongering? Can AI really take over complex white-collar roles that quickly? Let's unpack it. Where are the risks really concentrated? Where are these economic fault lines?
That is the right question. And the answer, it's complex, but it's also quite clear. It's not really about job titles. It's more about the structure of the tasks within those jobs. The sources consistently highlight that displacement risk. It's concentrated in roles heavy on predictive synthesis, repetitive data management, or maybe routine code generation. These can be complex, white-collar tasks, absolutely, yes, but they're also proving highly automatable. Basically, if your output is predictable or it's mainly about optimizing based on sorting existing data, that role faces immediate pressure.
And beyond just specific tasks, you mentioned a bigger structural issue in the market itself, this risk of market polarization.
Absolutely. This is the winner-take-all effect playing out in the AI landscape, and it's incredibly important for investment decisions. See, AI systems, they rely on 3 key things: massive proprietary data sets, huge computational scale, and frankly, concentrated top-tier talent. Only a few dominant global players can really afford to acquire and scale all 3 of those things at the same time.
Right, so those few companies get this overwhelming advantage, kind of huge data moat that smaller competitors just can't hope to cross.
Precisely. They end up accruing massive value, which creates this immense market polarization. And this matters profoundly for your portfolio because it implies that the risk tied to a traditional broad-based index investment like the classic 60/40 strategy is actually going up.
Wait, let's quickly clarify that. When we talk 60/40, for anyone less familiar, we mean that bedrock diversification model. 60% stocks, 40% bonds. Why is that specific time-tested model struggling against AI?
It's struggling because AI disruption is synchronizing risks in new ways. In the past, stocks dip, bonds usually give you a cushion. But AI disruption can create these sector-wide, even economy-wide shifts that hit all companies that haven't adapted. Doesn't matter the sector. If a handful of winners capture nearly all the growth, then broad market indexes get dragged down by all the non-adapters. You kind of have to choose which side of that fault line you want to be on.
Okay, so we know where the laggards and the repetitive tasks are likely concentrated. But let's pivot to the positive side. Where are the economic sectors, the roles, where human comparative advantage is likely to stick around or maybe even grow alongside AI?
Yeah, good question. We look for areas needing genuine novelty. Economic sectors where human complexity still reigns supreme. Think tasks requiring strategic ambiguity, cross-domain synthesis, deep psychological insight, novel scientific experimentation, applying ethical judgment. These are the areas where humans really thrive and where they can leverage AI as this incredibly powerful tool for acceleration, not just as a replacement for the core thinking.
That brings us right to the future-proof portfolio then. If that traditional 60/40 foundation is maybe eroding, what are the new investment pillars we should be thinking about building on?
The necessary shift is definitely moving toward assets that are fundamentally AI resistant, or even better, AI enabling. The sources point to three specific, pretty crucial pillars for portfolio construction moving forward. Pillar one, infrastructure. This is the absolute foundational hardware required for all this AI processing. Think of it like the old gold rush analogy. You don't necessarily bet on one gold miner. You buy stock in the companies selling the picks and shovels to all the miners. So we're talking specifically about chips, advanced semiconductors, and the massive data centers needed to train and run these huge AI models. AI processing is incredibly resource intensive, and that demand is just climbing exponentially.
That makes total sense. Someone has to build the actual physical pipes for all this data to flow through. Okay, what about pillar two?
Pillar two, enablers. This focuses on the technologies that support AI operations across the whole economy. So yes, this means cloud computing services that house and distribute the massive models, but we need to be a bit more specific here.
Okay, but cloud computing.
Yeah.
That sounds like maybe a safe bet from 5 years ago. What do the sources specify? Are we just looking at the big established giants, or is there more nuance?
That's exactly the nuance. We're looking beyond just the hyperscale giants, though they're part of it. The sources really highlight the specialized integrators, those firms specifically handling proprietary AI models, developing secure, scalable platforms for enterprises to actually apply AI effectively. So look for companies providing the crucial middleware, maybe specialized data ingestion services that allow traditional industries like healthcare or finance to consume AI without having to build it all themselves.
Ah, okay. That refines the target quite a bit. And the third pillar, that seems to address the unavoidable social side of this massive technological shift.
It really does. Pillar three, ethical AI solutions and collaborative AI. As AI gets embedded deeper into decision-making in finance, healthcare, everywhere, the demand for transparency, for auditability, for ethical frameworks, it's going to skyrocket. Companies developing these solutions or those focusing specifically on collaborative AI tools designed to enhance human decision-making rather than just replacing it outright, they'll be uniquely valuable. Investing here is basically betting on companies that succeed by boosting human productivity and trust, not just by raw automation speed.
This shift is really crucial. Okay, so we've talked about hedging your financial assets. But the sources, they make it crystal clear that maybe the most critical asset you own isn't even on a stock exchange. We absolutely need to talk about human capital, and this is where it gets really interesting. Moving beyond the stock market to your personal portfolio of skills. What are the future-proof personal assets in an AI-dominated landscape?
The message across the board is pretty unified. Your skills and your knowledge are now absolutely critical future-proof assets. If a machine can do the predictable task, the human needs to master the unpredictable, the relationship-driven, the original. We can probably detail three specific human skill areas that seem to resist automation, where our comparative advantage actually increases.
Okay, let's break those down. What's the first one?
The first is continuous learning. And this isn't just, attending a professional development seminar once a year. It's an operational necessity now. The half-life of knowledge is just collapsing. If you stop learning the new interfaces, the new regulations, the new ways AI is being applied in your field, your current skills will depreciate incredibly fast. Investing your time and resources into continuous upskilling, that's your most direct personal hedge against becoming obsolete.
Right, so continuous learning becomes like dynamic portfolio management, but for your career. Makes sense? What about the skills where humans just naturally outshine machines?
That leads directly to the second skill area, critical thinking and creativity. AI systems are fantastic at synthesizing existing patterns, finding optimal answers based on vast amounts of training data. But true human creativity, that involves formulating completely novel questions, challenging deeply held assumptions, maybe synthesizing ideas from totally disparate fields into something brand new. We need people who can interpret the AI's output, figure out if the initial question was maybe flawed, and know when to pivot if the data suggests something counterintuitive.
Okay, so the machine provides the optimized synthesis, maybe the first draft, and the human provides the novel
Right.
insight or the necessary skepticism or the strategic direction.
Precisely. And the third essential skill area is emotional intelligence and complex collaboration. As automation handles more routine tasks, the tasks left for humans are often those requiring navigating really complex social environments, managing diverse teams, building deep client trust, providing genuine leadership. These are areas where human rapport, empathy, understanding nuance, they create value that's, well, currently irreplaceable by algorithms.
Okay, so let's make this practical. If I, the listener, am currently, say, a mid-level data analyst, a role that seems clearly impacted by generative AI, which one of these three skills offers the fastest, maybe most direct personal hedge?
That's a great example. For a data analyst in that position, focusing immediately on critical thinking and creativity is probably key. You need to transition from processing the data to framing the business problem that the AI should be tasked with solving, and then, crucially, synthesizing the AI's results into strategic narratives that human stakeholders can understand and act on. You're essentially moving from execution towards interpretation and strategic counsel.
Wow, okay. That really reframes the entire job structure, doesn't it? Okay, we've gone from assessing the situation to financial hedging strategies and now to personal upskilling. Let's try to provide a clear framework for action now, tying it all together.
Right. The immediate step for you, listening now, is probably exposure assessment, and be ruthless about it. Do you work in a field that relies heavily on that predictive synthesis we talked about? Or, looking at your finances, are your investments maybe concentrated in companies that are clearly AI laggards? Once you've assessed, the step-by-step approach moves towards adjustment. When shifting your financial allocation, the sources strongly suggest focusing on those broad categories: infrastructure, enablers, and collaborative ethical AI solutions. Look for indices or perhaps funds that specifically target those foundational layers of the AI economy: the chips, the specialized cloud infrastructure.
And just to reiterate, this is all information based on our deep dive into these sources. It's absolutely not direct financial advice. But understanding these potentially resilient categories is definitely the first step towards building that long-term hedge. And then on the personal side, it's about starting to consciously dedicate time, maybe even budget, to skill acquisition in those three human domains: continuous learning, critical thinking, and emotional intelligence. So what does this all boil down to? I think the core call to action here is really to reject complacency. Start small, perhaps, but stay intensely informed about the exponential pace of this change. And adapt your financial strategy proactively by shifting focus, maybe gradually, from the old economy toward the new enablers.
And maybe if we connect this back to the bigger picture, that winner-take-all effect we discussed earlier, the idea that massive value might concentrate in just a handful of dominant AI companies. This raises a really important, maybe provocative question for you to consider after this. If that winner-take-all effect is somewhat inevitable in AI, what responsibilities does that incredibly concentrated value place on those few dominant players? And how might that massive centralization of power ultimately impact the broader markets and even the societal structure that we've just been discussing?
That is a profound question, touching on the kind of societal contract that might underpin this future market. Something definitely to chew on. Thank you for joining us on this deep dive into future-proofing your portfolio for the AI era. Stay curious, stay proactive, and we'll see you next time.